Welcome to the deep dive. Ever wondered how these huge companies just keep getting bigger? Or maybe how you make sense of the finances when one company basically, you know, swallows another one whole? Well, today we're diving right into that. We're looking at business combinations and consolidated financial statements. Sounds complicated, I know, but stick with us. This isn't just accounting jargon. It's really about understanding how companies fit their financial puzzle pieces together after a big merger or acquisition. Our mission today: cut through all that complexity, give you the key stuff so you can quickly get what's really going on when companies combine.
Exactly. And what's really fascinating, I think, is seeing how these combinations actually show up on the books and why that matters, to anyone looking at a company's real financial health. It's definitely more involved than just adding two sets of numbers together.
Okay, so let's start right at the beginning, the basics. When does one company's financial picture actually get blended, like totally merged with another's? You mentioned it really comes down to control, and there are, what, two main ways to think about that?
That's right. The most common path is what we call the voting interest model. This is where you prepare consolidated financial statements, that unified set of books when one company, the parent, gets control over another, the subsidiary. And control here usually just means buying more than 50% of the voting stock. Simple majority. Now, under U.S. GAAP, it's pretty strict. All majority-owned subsidiaries, doesn't matter if they're domestic or foreign, must be consolidated. That's the rule.
Must be consolidated. Okay. But, I mean, there have to be exceptions, right? Always are. When would a company not have to consolidate, even if they technically own more than half?
You got it. Yeah, there are definitely exceptions. It's crucial. While owning over 50% usually means control, sometimes that control isn't really effective, it's limited. So, for example, if the subsidiary is going through a legal reorganization or maybe even bankruptcy, or perhaps it operates under really severe foreign restrictions, where the government basically stops the parent from actually exercising control, in those specific cases, even with majority ownership, you don't consolidate because, well, the parent isn't truly in control.
Interesting. So control isn't just about the shares, it's about the actual ability to direct things. Okay, so what if a parent buys, say, 70% of a company, not the whole 100%? What happens to that other 30%? Who gets credit for that value?
Great question. That doesn't just disappear. That's where two key terms come in: controlling interest and non-controlling interest, or NCI. The controlling interest is what the parent owns, that 70% slice in your example. The non-controlling interest, NCI, is the rest, the equity or the net assets of the subsidiary that the parent doesn't own, so the 30%. And the really important part: this NCI isn't ignored. It gets reported at its fair value, right there in the equity section of the consolidated balance sheet. But it's shown separately from the parent's own equity. It clearly represents the stake of those other owners.
Okay, that makes sense for straightforward ownership. Over 50%, you consolidate, account for the NCI. But what if it's fuzzier? What if control isn't about voting stock? Maybe there isn't even a clear majority owner. This sounds like where that variable interest entity, the VIE model, comes in. And you hinted this can get complex.
Uh-huh. This is where things can get, well, a bit more nuanced, definitely. Variable interest entities, or VIEs, are basically legal structures. Think corporations, partnerships, trusts, LLCs. But they're set up in a way that's a little unusual. They might lack typical equity investors who have voting rights and control. Or maybe they just don't have enough of their own financial resources, their own equity, to support their activities without outside help. They need financial backing. So the company that ends up consolidating this VIE isn't necessarily the majority owner. It's called the primary beneficiary.
Primary beneficiary. Okay, so what makes a company the primary beneficiary?
The primary beneficiary is the one who has the power to direct the VIE's most significant activities, the things that really drive its economic performance. And this is key. They also either have to absorb the VIE's expected losses, or they get to receive its expected residual returns. Basically, they have the power and the economic exposure.
So power and the potential profit or loss, even without 50% ownership.
Exactly. And here's a critical rule, a passkey alert for you. Under U.S. GAAP, you always evaluate for consolidation under the VIE model first. Only if consolidation isn't required under the VIE rules do you then look at the voting interest model. It prioritizes substance over form.
Okay, VIE first.
Yeah.
Got it. So how do you even spot if you're dealing with a variable interest to begin with? Seems like the first step.
Right. There's kind of a 5-point checklist, conceptually. First, the company and the business entity need to have some kind of arrangement. Maybe the company was heavily involved in designing the entity, or the entity exists mainly to do things for the company, or the company gives it significant financial support. Things like securitizations or special leasing arrangements often fall here. Second, The business entity has to be a legal entity, a corporation, partnership, LLC, trust, something like that, not just an informal group. Third, the entity can't qualify for an exclusion. Certain types of entities like nonprofits, employee benefit plans, registered investment companies are generally exempt from VIE rules. Fourth, the interest has to be more than insignificant. We're not talking about tiny everyday transactions. The company's involvement needs to be big enough that they could potentially be the primary beneficiary. And fifth, the company must have an explicit or implicit variable interest. This just means they stand to absorb potential losses or receive potential returns from the entity. Examples: guarantees of debt, options, forward contracts, even most liabilities other than, say, short-term payables. Explicit means it's written down. Implicit might mean, we'd step in to protect our reputation even without a contract.
Wow, okay, that's quite a filter. So if you check those boxes, you know there's a variable interest. The next step is figuring out if the entity itself is actually a VIE.
Precisely. And there are specific characteristics that make an entity a VIE. One big one: it has an insufficient level of equity investment at risk. Basically, it can't fund its own operations without extra support, like guarantees or other subordinated financial help from the variable interest holders. Think of little corporation needing a loan guarantee from big shareholder to even get started. Little core is likely a VIE because its own equity isn't enough. If an entity can stand on its own 2 feet financially, it's probably not a VIE. Other signs: the equity holders as a group lack the power to make key decisions. Someone else is calling the shots. Or the equity holders don't have the obligation to absorb the entity's expected losses. Someone else bears the downside risk. Or conversely, they don't have the right to receive the expected residual returns. Someone else gets the upside. And this last one's a bit tricky: disproportionately few voting rights. If an investor provides most of the economic substance but gets very few votes, especially if the entity exists mainly for their benefit, that's a red flag. Like our Team LLC example. Gertie Inc. puts in 80% of the economic interest but only gets 10% voting rights, and Team LLC mainly makes stuff for Gertie. Team LLC is a VIE. If Team LLC sold to outsiders, it likely wouldn't be.
Okay, so it's really about looking past the formal structure to see who really controls things and who stands to gain or lose. So you've done the work, identified a variable interest, confirmed the entity as a VIE. Now what? Who actually consolidates it?
The primary beneficiary consolidates. Simple as that. And remember, that's the entity with both: the power to direct the VIE's key activities and the obligation to absorb losses or the right to receive returns. You need both power and economics. Now, if one party gets the returns and a different party absorbs the losses, which is unusual, but possible the one absorbing the losses is generally the one who consolidates. And it's also possible, interestingly, for an entity to be a VIE, but for no single party to meet the primary beneficiary criteria. In that case, nobody consolidates it. It just operates independently from an accounting perspective.
Oh, and just a quick mention for private companies. There's an alternative they can elect. For certain leasing arrangements between companies under common control, the lessor might not have to consolidate the lessee VIE if specific conditions are met. It's an optional simplification. All right, that is a deep dive into the why and when of consolidation, especially with those tricky VIEs. Now, let's switch gears a bit. Let's talk about the how. When a company actually buys another, how does the accounting work? This is the acquisition method, right? You called it putting together a jigsaw puzzle.
That's the one, the acquisition method. And the first piece of the puzzle is figuring out the acquisition price. The rule is the investment is valued at the fair value of whatever the acquirer gave up: cash, stock, debt, whatever, on the acquisition date. Super important. It's the closing date value, not the announcement date. So if Tag Inc. agrees to buy Subco using its stock, and the stock price is $10 when they announce, but it goes up to $14 by the time the deal closes.
Then the price is based on $14.
Exactly. If they used 1 million shares, the acquisition price is $14 million. If the stock had dropped to $7, the price would be $7 million. The market price at closing is what matters.
Okay, closing date, fair value. Got it. And you mentioned this acquisition method has like two really fundamental characteristics.
It does. Two really big things to grasp. First, you record 100% of the subsidiary's net assets at their fair value on the acquisition date. Doesn't matter if you bought 60% or 100%. All the subsidiary's assets and liabilities get remeasured to fair value on the consolidated books. Any difference between the purchase price plus NCI and this fair value becomes goodwill. Second, the subsidiary's entire equity section gets eliminated in consolidation. Their common stock, their APIC, their retained earnings, poof. Gone from the consolidated balance sheet. Consolidated equity will just be the parent's equity plus the fair value of any non-controlling interest.
Wow. Okay, so it really is a fresh start, a remeasurement, not just adding things up. You talked about eliminating journal entries to make this
Right.
happen. What exactly are those doing? Are they actual entries in the company system?
Ah, good clarification. No, they aren't typically entries in the parents' or subs' day-to-day books. They're consolidation adjustments, often done on a work paper or in the consolidation system, to arrive at the collect consolidated totals. Conceptually, these adjustments do a few key things. They eliminate the subsidiary's equity, common stock, APIC, retained earnings, taking their book value off the combined balance sheet. They eliminate the parent's investment in subsidiary account. Since the sub's assets and liabilities are now combined, the investment asset itself is redundant in the consolidated view. If there's NCI, they create the non-controlling interest account, recognizing its fair value in the consolidated equity section. They adjust the subsidiary's balance sheet items to fair value. This is the step up or step down we talked about. They record any identifiable intangible assets of the subsidiary at their fair value: patents, brands, customer lists, etc., that might not have been on the sub's books before. And finally, they recognize goodwill or a gain. This is the plug, the difference between the total consideration, acquisition cost plus NCIFV, and the fair value of the identifiable net assets acquired.
Okay, that makes sense. It's like a checklist for the work paper.
Yeah.
You mentioned eliminating the sub's equity common stock, APIC, retained earnings. I've heard accountants use the acronym CAR for that.
Yes, exactly. CIR is just a handy mnemonic. Common stock, additional paid-in capital, retained earnings. It represents the subsidiary's equity or their net book value, assets, liabilities, right at the acquisition date. Sometimes, if you're working with financial statements from after the acquisition date, you might need to calculate what that CRR was on the acquisition date. You'd basically reverse out any income earned and dividends paid by the sub between the acquisition date and the statement date to squeeze back to the original CIR number.
Got it. CR, book value at acquisition date. Makes sense. So once the deal is done, how does the parent company track this new subsidiary on its own, separate books, before consolidation?
Right, the parent needs its own records. The investment in subsidiary account on the parent's books starts at the fair value of the consideration given. Now, what about business combination costs? Things like legal fees, accounting fees, consulting fees. Those direct out-of-pocket costs and any indirect costs are just expensed by the parent as they happen. They don't get added to the investment cost. However, costs related to issuing stock, like SEC registration fees, underwriting fees, those are treated differently. They directly reduce the value assigned to the stock issued, usually by reducing additional paid-in capital. APA. So if big company pays $415,000 in stock for subcom, spends $35,000 on lawyers, and $20,000 on SEC fees, the $35K is an expense, but the $20K reduces APIC. The investment itself stays at $415.
Yeah. Expense the fees, but reduce APG for stock issuance costs. What about if the deal includes potential future payments?
Yes, contingent consideration. This is pretty common. It's an obligation to pay more later if certain targets are met, like future earnings goals. On the acquisition date, the parent has to estimate the fair value, the probable settlement cost of this future payment. They add this estimated amount to the investment and subsidiary account and at the same time record a liability, something like liability for expected value of contingent consideration. So if Big Co might pay another $85,000 if sub hits an income target and they think there's a 50% chance, they'd add $42,500, 85K 50%, to the investment cost and record a $42,500 liability. This increases the total consideration and therefore potentially the goodwill.
Okay, so even potential future payments get estimated and included upfront.
Yeah.
Now, after the acquisition, how does the parent account for this investment internally, day to day?
Good question. For its own internal records, the parent typically uses either the cost method or the equity method. And here's another passkey for you. Remember, these methods are only for the parent's separate books. The investment in subsidiary account gets eliminated anyway when preparing the consolidated statements. Under the cost method, the investment account basically just sits there at its original cost. Any dividends the parent receives from the sub are recorded as dividend income. Simple, but doesn't reflect the sub's ongoing performance. The equity method is more involved, but often more informative. The investment account increases by the parent's share of the subsidiary's net income, and it decreases when the parent receives dividends from the sub. The parent records its share of the sub's income as equity and subsidiary income. The big advantage of the equity method is that the parent's investment account tracks the changes in the subsidiary's underlying equity, which can actually make the consolidation elimination process a bit smoother later on.
Right, because the parent's books already reflect some of the changes you'd need to adjust for. Makes sense. We talked about non-controlling interest, NCI, earlier, the part the parent doesn't own. Can we dig a bit deeper into how that shows up, both initially and ongoing?
Absolutely. NCI is a significant piece of the consolidated picture. On the balance sheet, as we said, it's reported at fair value in the equity section, but separate from the parent's equity. Importantly, this initial fair value calculation includes the NCI's proportionate share of any goodwill calculated in the acquisition. So if the total fair value of the subsidiary is calculated, the NCI percentage is applied to that total value, including goodwill, to get the initial NCI amount. After the acquisition date, the NCI balance changes over time. It's basically accounted for using the equity method from the NCI perspective. You take the beginning NCI balance, add the NCI share of the subsidiary's net income for the period, and subtract the NCI share of any dividends the subsidiary paid out. That gives you the ending NCI.
Okay, so it's like a separate little equity account that tracks the other owner's share of the subsidiary's performance. What about on the income statement?
On the income statement, the consolidated statement includes 100% of the subsidiary's revenues and expenses from the acquisition date forward. All of it rolls up. But then, near the bottom, before you get to the final consolidated net income, you show a line item that deducts the portion of that income attributable to the non-controlling interest. So you'll see something like net income attributable to non-controlling interest. This is usually calculated simply as the subsidiary's net income for the period multiplied by the NCI ownership percentage. This clearly shows how much of the subsidiary's profit belongs to the NCI shareholders versus how much belongs to the parent company's shareholders. It's all about transparency.
Transparency.
Right.
Showing the whole picture, then carving out the NCI slice. Okay, let's circle back to those big adjustments you mentioned. Fair value adjustments, those identifiable intangibles, and the big one, goodwill, or sometimes even a gain. This feels like where the major revaluation happens.
It absolutely is. This is often where the largest dollar adjustments occur. Remember, the fair value of a subsidiary is the sum of the acquisition cost, what the parent paid, plus the fair value of the NCI. When this total fair value is different from the subsidiary's old book value of net assets, their CAR, we adjust in three main areas. One, adjust the subsidiary's existing tangible assets and liabilities to fair value. Buildings, equipment, debt, everything gets marked to market. Two, record identifiable intangible assets at fair value. Think brand names, patents, customer lists, even in-process R&D projects. These might have had zero value on the sub's books before. Three, the leftover difference becomes either goodwill or a gain.
Okay, let's break down goodwill first. When does that happen?
You get acquisition with goodwill when the fair value of the subsidiary, acquisition cost plus NCI FE, is more than the fair value of 100% of the subsidiary's identifiable net assets, the stuff you could actually point to and value separately. You paid a premium. So, step one, adjust the balance sheet to fair value. Step two, record all those identifiable intangible assets at fair value. Crucially, things like in-process R&D are capitalized as assets here, not expensed immediately. These intangibles are then assessed. Do they have a finite life, like a patent? If yes, amortize them over that life and test for impairment. Do they have an indefinite life, like a strong brand? If yes, don't amortize, but test for impairment at least annually. Step 3. Whatever premium is left after allocating value to all identifiable tangible and intangible assets is goodwill. It represents synergies, future growth potential, things you can't specifically identify but paid for. Goodwill isn't amortized, but it must be tested regularly for impairment. If its value drops, you record an impairment loss, which is an expense.
So goodwill is the ultimate residual, the premium paid above the fair value of everything else you could identify.
Precisely. And just a quick note, again, for private companies, they have an option, an accounting alternative, where they can elect not to separately recognize certain customer-related intangibles or non-compete agreements. If they make that election, the value just gets lumped into goodwill. They usually have to elect an alternative for goodwill amortization, too, if they do this.
Okay, now, what about the flip side? The bargain purchase. When you get a gain, that sounds almost too good to be true.
It does, but it happens. An acquisition with a gain occurs when the fair value of the subsidiary is less than the fair value of 100% of its identifiable net assets. You essentially paid less than the stuff was worth. The steps are similar, but the outcome's different. Step 1, adjust the balance sheet assets and liabilities to fair value. Step 2, record identifiable intangible assets at fair value. Step 3, after doing all that, if you still have a negative balance, meaning the fair value of net assets exceeds the price paid, that negative amount is recorded immediately as a gain on the income statement in the period of acquisition. So if Gertie pays $1 million for Subco, but after marking everything to fair value, Subco's identifiable net assets are worth $1.2 million, Gertie records a $200,000 gain right away.
Wow. A gain just for making a good deal. Okay,
Yeah.
one final piece here. What if, a few months after the deal closes, the company gets better information about those fair values they estimated? Can they fix them?
Yes, they can within a specific window. These are called measurement period adjustments. US GAAP recognizes that getting perfect fair values on the acquisition date itself can be tough. So, companies have up to 1 year from the acquisition date, the measurement period, to adjust the provisional amounts recorded if they get new information about conditions that existed at the acquisition date. Maybe a final appraisal comes in higher, or they uncover a liability they didn't know about. These adjustments are typically offset against goodwill or the gain. So, if an asset's fair value goes up, goodwill goes down, or vice versa. Any resulting changes to depreciation or amortization based on these adjusted values are recorded in the current period. You don't restate past periods. But crucially, this is important. Adjustments are only for information about conditions at the acquisition date. Changes in value that happen after the acquisition because of later events, those are not measurement period adjustments. They're just normal business results.
Okay, so a 1-year window to refine the numbers based on acquisition date facts impacting goodwill. Got it. So bringing this all together, what does this mean for you listening in? We've covered a lot of ground, from the basics of control with the voting interest model through the complexities of VIEs and into the nitty-gritty of the acquisition method, fair values, NCI, intangibles, goodwill, gains, even those measurement period tweaks. Hopefully, you now have a much clearer picture, a solid framework for understanding how these massive corporate combinations actually come together on the financial statements.
And maybe this prompts a new question for you. The next time you see a headline about a big company buying another one, how will you think about it differently now? Will you look past just the purchase price? Will you consider those hidden intangible assets, the potential for goodwill, or even a gain, and how that NCI fits into the picture? It's definitely more than just the initial price tag.
Absolutely. Keep that curiosity sparking.
Yeah.
Thanks for joining us on this deep dive. We'll catch you next time.